Chapter number 8. Source of Business Finance. Business finance. Financing is an art of providing fund for a business activity, making purchase or investment. Financial institutions and banks are in the business of financing as they provide capital to business, consumers and investors to help them achieve their goal. Business finance can be categorized into two groups. Fixed capital. Fixed capital investment represent the acquisition and maintenance of long-term asset. A fixed capital investment can be tangible asset such as building or an intangible asset such as intellectual property. Second type, working capital. Working capital refers to deployment of financial resource in the day-to-day business operation. Investing in working capital involve acquiring short-term assets and incurring short-term liability. Financial need of business. First one is start a business. Depending on type of business, it will need to finance the purchase of assets, materials and employing people. They will also need to be money to cover running cost. Finance expansion to production capacity. As business grow, it need higher capacity and new technology to cut unit cost and keep up with the competitors. New technology can relatively expensive to the business and is seen as a long-term investment because the cost will overweight the money saved. To develop and market a new product. In a fast moving market where competitors are constantly updating their product, a business need to spend money on developing and marketing new products. Moving to new premises. Finance is needed to pay for simple expenses such as the cost and renting of removal vans through relocation package for employees and the installation of machinery. Difference between fixed capital and working capital. Meaning, fixed capital refers to the investment of enterprise in long-term asset of the company. Working capital means the capital invested in the current asset of the company, comprise of durable goods whose useful life is more than one accounting period, short-term assets and liability in working capital. Liquidity in fixed capital, comparatively liquidity in working capital, highly liquidity. Use in fixed capital, used to buy non-current assets for business, use for short-term financing. Service in fixed capital, strategic objectives. In working capital, operational objective. Classification of source of fund. Source of fund classification. We have a three category on the basis of period, on the basis of ownership, on the basis of source of generation. On the basis of period, we have again three category: long term, medium term, short term. On the basis of ownership, we have a two category: owner's fund, borrower's fund. On the basis of source of generation, we have a two category: internal source, external source. This is an overview of this chapter. Classification of source of fund on the basis of period, which will be calculated based on the number of days, years, like that. First one, long-term source. It includes those sources which are required by the business firms for period exceeding 5 years. For example, shares, debentures. Medium-term source. It includes those funds which are required for period of more than year but less than 5 years. For example, public deposit borrowings from commercial banks. Short-term source. It includes those sources which are required by the business firms for a period of less than 1 year. For example, trade credit, commercial paper. On the basis of ownership. The first one, owner's fund. It refers to the fund contributed by owners as well as the accumulated profit of the company. This fund remains with the company and it has no liability to return this fund. Example, equity share, retained earning. On the basis of ownership basis, the second category, borrowing funds. It refers to borrowing of the firm. It includes all funds available by way of loan or credit. Third one, on the basis of source of generation basis. First one, internal source. Internal source of finance are fund from inside the business. For example, profit can be kept back for a finance expansion. Second point, external source. The term external source of finance or capital itself suggests that very nature of finance or capital. External source of finance are equity capital, preferential stock, debentures, term loans, venture capital, leasing, hire purchase, trade credit, bank overdraft, factoring, etc. Source of finance, retained earning. Company general does not distribute all its earning among the shareholders as dividends. A proportion of net earnings may be retained in the business for use in the future. Its merits. Retained earning is a permanent source of fund available to an organization. It does not involve any explicit cost in the form of interest or dividend. As the funds are generated internally, there is a greater degree of operational freedom and flexibility. It enhances the capacity of a business to absorb unexpected loss. It may lead to increase in the market price of the equity share of company. Limitation. Excessive flogging, that means use or taking out back, may cause dissatisfaction among the shareholders as they would get lower dividend. It is an uncertainty source of a fund as the profit of a business are fluctuating. The opportunity cost associated with these funds is not recognized by many firms. This may lead to suboptimal use of fund. Lack of sufficient fund. Trade credit. Trade credit is an essential tool for financing growth. Trade credit is the credit extended to you by suppliers who let you buy now and pay later. Anytime you can take delivery of a material, equipment or other valuables without paying cash on spot. Merits. Trade credit is a convenient and continuous source of fund. Trade credit may be readily available in case the credit worthiness of consumer is known to the seller. Trade credit needs to promote the sales of organization. If organization want to increase its inventory level in order to meet expected rise in the sale volume in the near future, it does not create any charge on asset of the firm. Limitation. Availability of easy and flexible trade credit facility may include a firm to spoil in over trading, which may add to the risk of firm. Only limited amount of funds can be generated through the trade credit. It is generally a costly source of fund as compared to the most of other source of raising money. Factoring, a financing method in which business owners sell accounts receivable at a discount to third-party funding source to raise capital. Merits. Obtaining funds through factoring is cheaper than financing through other means such as banks credit. With cash flow accelerated by factoring, the client is able to meet his or her liabilities promptly as and when these arise. Factoring as a source of fund is flexible and ensure a definite pattern of cash inflow from credit sales. It provides security for debts. It does not create any charge on the asset of the firm. The client can concentrate on other functional areas of business as the responsibility of credit control is taken by the factor. Limitation. This source is expensive when the invoices are numerous and small in amount. The advance finance provided by the factor firm is generally available at higher interest costs than the usual rate of interest. The factor is third party to the customer who may not feel comfortable while dealing with it. Fourth point, lack of interest towards selling. Lease financing. A lease is a contractual agreement whereby the owners of an asset, leaser, grants the right to use the assets to the other party, leasee. Merits. It enables the leasee to acquire the asset with a low investment. Simple documentation makes it easier to finance assets. Lease rentals paid by the leasee are for computing taxable profit. That means tax deduction. It provides finance without diluting or weakening the ownership or control of business. The lease agreement does not affect the debit raising capacity of an enterprise. Limitation. A lease agreement may impose certain restriction on the use of assets. For example, it may not allow the leasee to make any alteration or modification in the asset. The normal business operation may be affected in case of lease is not renewed. It may result in higher payout obligations or a duty in case the equipment is not found useful and the leasee opts for premature termination of lease agreement. The leasee never becomes the owner of asset. Public deposits. A company can raise funds by inviting the public to deposit their savings with their company. Public deposits may take care of both long and short-term financial requirements of business. Rate of interest on deposits is usually higher than that offered by banks and other financial institutions. Merits. The procedure of obtaining deposit is simple and does not contain restrictive conditions as are generally there in a loan agreement. Cost of public deposits is generally lower than the cost of borrowings from banks and financial institutions. Public deposit does not usually create any charge on the asset of a company. As the depositors does not have voting right, the control of the company is not diluted. Limitation. New companies generally find it difficult to raise a fund through public deposits. It is a variable source of finance as the public may not respond when the company need money. Collection of public deposit may provide difficult, particularly when the size of deposit required is large. Commercial paper. CP, nothing but commercial paper. It is an unsecured promissory note issued by a firm to raise fund for a short period. The maturity period of commercial paper usually range from 90 days to 364 days. Being unsecured, only firm having good credit rating can issue the CP and its regulation come under the purview of Reserve Bank of India. Merits. A commercial paper is sold on unsecured basis and does not contain any restrictive condition. As it is freely transferable instrument, it has highly liquidity. It provides more fund compared to other sources. Generally, the cost of CP to the issuing firm is lower than the cost of commercial bank loans. A commercial paper provides a continuous source of fund. This is because their maturity can be tailored to suit the requirement of issuing firm. Further, maturing commercial paper can be repaid by selling a new commercial paper. Limitation. Only financially sound and highly rated firm can raise money through commercial paper. The size of money that can be raised through commercial paper is limited to particular time. Extending the maturity of CP is not possible. Issue of shares. We have two types of shares: equity shares, preferential shares. Equity shares. Issue of equity shares. It represents the ownership capital of a company due to their fluctuating earnings. Equity shareholders are called risk bearer of a company. The shareholders enjoy higher returns during prosperity, have a say in the management of a company through existing their voting right. Merits. Equity shares are suitable for investors who are willing to assume risk for higher return. Payment of dividend to the equity shareholders is not compulsory, therefore there is no burden on the company. Equity capital serves as a permanent capital as it is to be repaid only at time of liquidation of company. It provides credit worthiness to the company and confidence to forthcoming loan providers. Fund can be raised through equity issue without creating any charge on the asset of company. Democratic control. Democratic control over management of a company is assured due to voting right of equity shareholders. Limitation. Equity share get fluctuating returns. The cost of equity shares is generally more as compared to cost of raising fund through other source. Issue of additional equity share dilutes or divides the voting power and earnings of existing equity shareholders. More formalities and procedural delay are involved while raising fund through issue of equity shares. B. Preferential shares. These shares provide preferential right to the shareholders with respect to payment of earnings and the repayment of capital. Investors who prefer steady income without undertaking higher risk prefer their shares. A company can issue different types of preferential shares. Merits. Preferential shares provides reasonably steady income in the form of fixed rate of returns and safety of investment. Preference shares are useful to those investors who want fixed rate of return with comparatively low risk. Preferential shareholders don't have voting right. Payment of fixed rate of dividend to preference shares may enable a company to declare higher rate of dividend for equity shareholders. Preference shareholders have preferential right of payment over equity shareholders in the event of liquidation of company. Preference capital does not create any sort of charge against the asset of company. Limitation: preference shares are not suitable for those investors who are willing to take risk and are interested in higher return. Preference capital dilute or weaken the claim of equity shareholders over the asset of company. The rate of dividend on preference shares is generally higher than the rate of interest of debentures. As the dividend on these shares is to be paid only when the company earns profit, there is no assured return for the investors. Debentures. Issue of debentures. It represents the loan capital of a company and the holders of debentures are the creditors. These are the fixed charge fund that carry a fixed rate of interest. The issue of debenture is suitable in the situation when the sale and the earning of the company are relatively stable. Merits. It is preferred by the investors who want fixed income at lesser risk. Debentures are fixed charge funds and do not participate in profit of the company. Debentures do not carry voting rights. Financing through debenture does not dilute control of equity shareholders on management. Financing through debenture is less costly. The interest payment on debenture is tax deductible. Limitation: as fixed charge instruments, debenture put permanent burden on earnings of company. In case of redeemable debenture, certain date, that means redeemable means the company has to make provision for repayment on the specified date even during period of financial difficulties. Each company has certain borrowing capacity with the issue of debenture. Commercial banks. Banks provide short and medium-term loan to firms of all size. The loan is repaid either in lump sum or in installment. The rate of interest charged by a bank depends upon factors influencing the characteristics of borrowing firm and the level of interest rate in the economy. Merits. Banks provides timely assistance to business by providing funds as and when needed by it. Secrecy of business can be maintained as the information supplied to the bank by the borrowers is kept confidential. Formalities such as issue of prospectus and underwriting are not required for raising loan from bank. Loan from bank is flexible source of finance as the loan amount can be increased according to the need and can be repaid in advance. Limitation: funds are generally available for short period and its extension or renewal is uncertain and difficult. Bank makes detailed investigation of the company's affairs, financial structure, etc. and may also ask for security of assets and personal sureties. In some cases, difficult terms and conditions are imposed by banks for the grant of loan. Example, restriction may be imposed on the sale of mortgaged goods. Financial institutions. Both central and state governments have established a number of financial institutions all over the country to provide industrial finance to companies engaged in business. They are also called development banks. This source of financing is considered suitable when large funds are required for expansion, reorganization, and modernization of enterprise. Merits. Financial institutions provide long-term finance. These institutions provide financial, managerial, and technical advice and consultancy to the business firm. Obtaining loan from financial institution increase the goodwill of the borrowing company in the capital market. Consequently, such a company can raise fund easily from other sources as well. As repayment of loan can be made in easy installment, it does not prove to be much of a burden on the business. The funds are made available even during period of depression. Limitation. Financial institutions follow rigid criteria for grant of loans. Too many formalities makes a procedure time-consuming and expensive. Certain restrictions such as restriction on dividend payment are imposed on the power of borrowing company by the financial institutions. Financial institutions may have their nominee on the board of directors of a borrowing company, thereby restricting the power of a company. International financing. International financing is the branch of financial economics broadly concerned with monetary and macroeconomic interrelation between two or more countries. Various international sources from funds may be generated. First one, commercial banks, international agencies and development banks. Third one, international capital market. In international capital market, we have a three category: global depository receipt (GDR), American depository receipt (ADR), foreign currency convertible bonds (FCCBS). First one, commercial banks. Commercial banks all over the world extended foreign currency loans for business purpose. They are an important source of financing non-trade international operations. The type of loan and service provided by banks vary from country to country. Example, Standard Chartered emerged as a major source of foreign currency loan to the Indian industries. International agencies and development banks. These bodies provide long and medium-term loans and grant to promote the development of economically backward areas in the world and international level for funding various projects. International Finance Corporation, IFSC, Exim Bank and Asian Development Bank. These are the other banks which help to develop the industries in all over the world. Global Depository Receipt (GDR). The local currency share of a company are delivered to the depository bank. The depository bank issue depository receipt against these shares. Such depository receipt denominated in US dollar are known as Global Depository Receipt. GDR is negotiable instrument and can be traded freely like any other securities. American Depository Receipt (ADRs). The depository receipt issued by a company in US are known as American Depository Receipt. ADRs are bought and sold in American market like regular stocks. It is similar to GDR except that can be issued only to American citizens and can be listed and traded on Stock Exchange of USA. Foreign Currency Convertible Bonds (FCCBS). Foreign currency convertible bonds are equity-like debit securities that are to be converted into equity or depository receipt after a specified period. Thus, a holder of FCCB has the option of either converting them into equity shares at predetermined price or exchange rate. IDR. Indian Depository Receipt. It is a financial instrument denominated in Indian rupees in the form of depository receipt. It is created by Indian Depository to enable a foreign company to raise funds from the Indian security market. Factor affecting the choice of source of funds. The first one, cost will affect when choosing a source of fund. So second one, financial strength and stability of operation. In the choice of source of funds, business should be in a sound financial position so as to be able to repay the principal amount and interest on the borrowed amount. Form of organization and legal status will also affect the choice of source of business fund. The fourth one, purpose and the time period will also affect of choice of the source of funds. Control. A particular source of fund may affect the control and the power of the owners on the management of the firm. Effects on creditworthiness. It will also affect choice of the source of fund. Flexibility and ease. Flexibility and ease of obtaining funds. Restrictive provisions, detailed investigation and documentation in case of borrowing from banks and financial institutions. Tax benefits. Various sources may also be weighed in terms of their tax benefits. Interest paid on debentures and loans is tax deductible. Thank you.